Most investors think options are only for experts or for people trying to make quick money. But the truth is completely different. Options are one of the simplest and most powerful tools to protect your investments, not gamble them away. When the market falls, most investors panic, watch their portfolio lose value, and hope things recover someday. But disciplined investors use options to limit losses, hedge risks, and stay profitable even in unpredictable markets. If you've ever been afraid of downturn, confused about volatility, or worried about your portfolio crashing, this video will show you how options can act like low-cost insurance for your wealth. By the end, you'll understand how beginners can use options safely without taking huge risks, and how you can protect your portfolio like a professional. Options also give you peace of mind, allowing you to sleep better at night knowing your investments are shielded. They aren't just financial tools, they are tools for mental clarity and discipline in investing. 1. What are options? Explain. Simply for beginners, options are contracts that give you the right, not the obligation, to buy or sell a stock at a set price, making them one of the most flexible tools in investing. Think of them as insurance policies for your portfolio. They protect you when the unexpected happens and give you control during volatility. Unlike buying stocks, options let you manage risk using far less money while maximizing strategic flexibility. They help you reduce uncertainty, create clear protection levels, and avoid emotional decision-making. Instead of predicting the market, you set rules that automatically safeguard your investments. This makes protection simple, structured, and suitable even for beginners. They also allow investors to experiment with strategies on a small scale, building confidence before scaling larger. Over time, options can become an essential part of any long-term portfolio, not just a short-term hedge. 2. Why protection matters more than profit. Most investors focus only on growth, hoping their portfolio will keep rising. But growth means nothing if one market crash can destroy years of progress. Protection ensures your gains stay intact no matter what the market does. Options provide a safety net during volatility, corrections, recessions, or unexpected global events. Even small hedges can prevent massive losses that take years to recover from. Smart investors know that defending wealth is as important as building it. The goal isn't to avoid risk. It's to manage it effectively so your portfolio can grow with confidence and stability. Protection also reduces stress, making it easier to stick to long-term plans instead of making impulsive moves. With proper hedging, you can participate in growth without constantly worrying about downturns. 3. The protective put, your portfolio's safety shield. A protective put is one of the simplest and safest option strategies beginners can use, giving you a guaranteed minimum selling price for a stock you already own. If the market drops, your put option increases in value and cushions your losses automatically. If the market rises, you still keep all your gains. The put simply expires like an insurance policy you didn't need to use. This strategy removes fear, protects your downside, and keeps your upside open. It's perfect for volatile markets, uncertain economic periods, or when you want to lock in profits. With one simple step, you add a protection layer that works silently in the background. Protective puts also allow you to maintain exposure to long-term growth while avoiding catastrophic losses. They teach beginners discipline and risk management early in their investing journey. 4. The covered call, earn income while reducing risk. A covered call allows you to generate passive income from stocks you already own by selling a call option and collecting a premium upfront. This income lowers your overall cost and reduces your risk even if the stock moves sideways or drops slightly. You give up some potential upside, but in return, you gain steady, predictable cash flow. This strategy works best for stable long-term holdings and investors who want consistent returns. It helps you stay profitable during slow markets where growth is limited. For many long-term investors, covered calls are one of the safest and most reliable income strategies available. Covered calls also encourage careful selection of stocks and monitoring of risk, building better investing habits over time. They are ideal for retirees or anyone seeking supplemental income without selling core holdings. 5. The collar strategy, maximum protection with minimum cost. A collar combines a protective put with a covered call, giving you downside protection at a very low, sometimes even zero, net cost. The premium you earn from selling the call helps pay for the put, making this hedge incredibly efficient. Your downside becomes limited, your upside becomes defined, and your risk becomes controlled. This strategy is ideal for long-term investors who want stable returns without exposing their portfolio to major drawdowns. It's especially powerful during high volatility or after large gains you want to secure. For investors concerned about uncertainty, the collar is one of the strongest tools for peace of mind. Collars allow you to plan your returns and protect profits without constant monitoring. They also create confidence in holding positions through turbulent market phases. 6. How much protection do you really need? Every investor has a unique risk tolerance, time horizon, and financial goal, meaning the right level of protection varies from person to person. You don't need to hedge your entire portfolio. Even protecting 20–30% can significantly reduce losses. Short-term hedges are useful during elections, earnings seasons, or major economic news. Long-term hedges help you guard against recessions or global instability. The key is consistency. Protection must be planned before trouble arrives. A well-balanced hedge prevents emotional reactions and keeps your long-term strategy intact. Even partial hedges can save years of growth from being wiped out in a single downturn. Knowing your comfort zone with risk allows you to apply options intelligently and confidently. 7. When should you use options for protection? The best time to protect your portfolio is before markets become unstable, not during the chaos. Options are cheapest when volatility is low, making hedges more affordable and effective. You can use options to prepare for high-risk events, economic shifts, interest rate changes, or company earnings. They also help secure large gains you don't want to lose. By hedging proactively, you stay one step ahead of market uncertainty. The smartest investors protect themselves early, not when it's already too late. Using options proactively also builds mental discipline, reducing the temptation to make rash decisions in volatile markets. It's a strategy that rewards patience and foresight over reactionary trading. 8 honest common mistakes. Many beginners misuse options because they treat them like quick profit tools rather than protective strategies. Some take unnecessary risks by choosing the wrong strike prices or expiration dates. Others misunderstand leverage and end up overexposed without realizing it. Emotional trading often leads to impulsive decisions that destroy consistency. The biggest mistake is thinking options are complicated, when in reality their safest uses are simple and structured. Avoiding these errors helps you use options the way professionals do, calmly, strategically, and with purpose. Mistakes also include ignoring transaction costs or monitoring positions too frequently, which can erode profits. Learning from these pitfalls early ensures your protection strategies remain effective. 9. Build a simple options protection plan. Start by selecting one stock or ETF you want to protect. Then decide how much downside risk you're willing to tolerate. Choose whether a protective put, covered call, or collar aligns with your goal and time horizon. Set clear rules for entering and exiting hedges so your decisions remain disciplined. Review your protection regularly and adjust as your portfolio grows. This simple plan builds confidence, reduces fear, and gives you a structured method to handle market uncertainty. With consistency, your investments become more stable and resilient. Having a formal plan reduces stress during market swings and prevents emotional decision-making. It also provides a clear roadmap for scaling your option strategy over time. 10. The goal: reduce fear, increase control. Options are not tools for taking bigger risks. They're tools for reducing them. They give you the power to manage uncertainty, avoid emotional selling, and stay invested during market volatility. A protected portfolio recovers faster, compounds better, and grows more consistently over time. By preventing big losses, options help you stay focused on long-term goals instead of short-term fear. This is how true wealth is built, through calm decisions, strong strategy, and smart protection. With the right tools, you gain control even in unpredictable markets. Using options properly changes your mindset from fear-driven investing to strategy-driven growth. It's a way to take proactive control of your financial future instead of reacting to every market shock. If this video helped you understand how options can protect your portfolio, now is the perfect time to start learning these strategies step by step. Begin with simple defensive hedges, stay consistent, and avoid emotional decisions when markets get tough. Share this video with someone who fears market downturns. Hit the like button to support the channel, and subscribe for more smart investing guides. Remember, wealth isn't built by avoiding risk. It's built by managing it with discipline and clarity. Options give you control, confidence, and a way to grow your portfolio without constantly fearing the market. Start small, stay patient, and let protection work silently in the background to build long-term wealth.